Hello, Dr. Flight here. We're going to talk a little bit in this segment about managing growth or managing products through the growth cycle and the product life cycle specifically. I'm going to spend a little bit of time talking about issues that pioneers or the leaders have in terms of the growth stage. The other factor is managing different expectations for followers and how specifically followers will view a growth market as a real potential opportunity for them to get into. So one of the hallmarks of the growth stage of the product life cycle is that followers in particular see lots of opportunity for profit because they view pioneers as potentially vulnerable, or they view the opportunities to come into the marketplace because they have maybe a new and improved version of the product that the pioneer has emerged in. The other issue that's really important is that during the growth stage, the growth is coming from demand. Consumers are wanting the product. So for a period of time, there'll be more demand than there will be supply for a particular good. And so followers will look at that and they'll see lots of opportunity to be able to meet this unmet demand. And for a period of time, there'll be undercapacity that firms won't be able to meet the demand. However, so many competitors come in, so many followers jump in, then that very often switches to a situation where there's overcapacity, and then we have firms leaving the industry in the shakeout period. So this discussion then talks a little bit about how pioneers and followers then view growth markets and how they can compete and they can manage their way through that period of time in the product life cycle. Okay, this stage of the product life cycle is focused on rapid sales growth, increased advertising and expenses to build awareness, which then dissipate once the product takes off. The challenge, of course, is to be able to defend against competitors that now see the product and product category as a profitable area to do business in. So pioneers especially have to be able to protect themselves from the onslaught of oncoming competitors. So the goals then, as we move forward into the growth stage, especially for pioneers, deal with being able to maintain and grow their customer base. So they want to be able to continue to retain their customers that they've grown and established in the introduction phase. And they want to be able to attract new customers to the product category. So customers that would be new to the product category, and also retain those that they've already sold to. Because what's happening is that there's a market, but then that market is also growing. So there's a dynamic function that's happening. Not only are you selling to customers in the market, but the market's also growing at the same time. So you want to actively capture those new market members that are coming in that weren't in the market before during the introduction stage. So not only do you want to maintain your market share by retaining customers and getting a piece of that growing pie, but you also want to focus on your share growth, and as a company, because you're in a growing market, you want your share growth to be larger or grow faster than the industry's growth overall. If you're doing that, then you're successfully going to defend yourself against competition. It's kind of like it's kind of like a small pond that's rapidly filling up with water. You want to be able to grow faster than the pond is. So you want to stay large, but you want to actually do so by growing faster than the rate of growth around you. So it's a relative type of a thing. But that's what you want to focus on as again, this is as a pioneer or as a leader in this industry. Remember that the growth stage is relatively short. We're going to be moving into the shakeout phase fairly quickly. So we need to be able to capture as much market share again as we can. Competitors coming in are going to represent a fairly significant issue for the firm moving forward. So talking about the followers and talking about those competitors who are coming in, the question is, should I jump into this market or should I not? Should I hold off? Is this market attractive for me, and is it something that I think I should be participating in? There's a number of different things that followers will consider as they move into a marketplace. They want to be able to gain share. So they want to analyze the market and themselves, and they want to say, well, can I take some market share away from the pioneer? And am I suited for this marketplace and this product? Want to think about gaining share, pricing for competition, and then also thinking about being able to keep the technical expertise moving forward. So we're going to talk a little bit about each of these types of things in a little bit more detail. And again, these are things that followers would consider as they're reviewing a market in order to enter. And some of these are cautions as well. All right, so gaining share, if we perceive gaining share to be easy, then this will be something that we'll want to jump right into. So we'll be attracted to a market then if we think that the current pioneer or the current competitors who serve that market are underserving certain market segments. Okay, so if there are certain market segments that we feel are not being served well, then this is an opportunity for us to come in and be able to cherry pick consumer segments that we can be able to jump right into. We might also feel like we can gain this market share if we feel like the pioneers or the leaders who are already in the market are susceptible to weaknesses in their design where we can innovate better, or we can offer a slightly lower price, and if we don't feel like the leaders can match our price, then again, they'll be vulnerable to lose market share as we enter the marketplace, and so that would make a market attractive to us. We might also think about the competitors who are in there in a second sense, who might be weak, or we might perceive them as being weak, or ones that we feel like we could do some advertising and some positioning towards them, and they would not be able to address us. So if we act aggressively in the marketplace, they might not be willing to aggressively match our appeal. And again, if it's a weak competitor, for any number of reasons, they might not want to compete with us directly. Then that, of course, would produce a very attractive market for us to think about. So this assumes, though, that the competitors or the followers that or the leaders that we're really focused on are simply willing to maintain their growth. Earlier we said that pioneers and leaders are going to want to grow their growth, not just simply maintain their growth or market share after the introduction stage. This may be a little misleading, be a little misconceived, or because the market is growing. If a firm or a leader is perceived to only want to maintain, this could send a follower into a false sense of security. Most leaders or pioneers want to grow, not just maintain sales, but grow relative market size. And so we've got to be a little bit careful thinking that the leaders or the pioneers are going to just sit back and allow us to take market share away from them. This graphic illustrates that pioneers or leaders early on in the product life cycle, of course, represent all of the sales, but even in the end, they still maintain a huge percentage of share. After followers and after late entrants come into the marketplace, they're still big market share leaders. So it's not like we're going to eliminate the leader. They're still going to fight for their share. We just have to think that we're going to be able to take some of their share away, but probably not all of it. Okay, so an attractive market for a follower then will be one where we feel like market share can be gained, and we can gain it. Obviously, we have some cautions though moving forward. One of the concepts here is that when we jump into the marketplace, when we gain a customer today, the customer will continue to grow and provide a future cash flow for us. And so one of the motivations then for the follower to jump into the marketplace early is that we can capture market share early and then be able to grow that market share or grow the value of that sale of those customers over time. And a customer that is mine today is worth more than a customer that I acquire later on down the road. Okay, so if we view customers as future cash flows that will continue to buy our products, then we want to get in as early as possible in order to ride that customer through their customer life that's with us. So these gains in market share, then we sometimes think about them in terms of their present value and how much they're worth to us today. Things that are influences then that impact the value of the customer down the road is something called a network effect. Again, it's an effect where one customer brings in other customers, and they share the technology together. So if I sell the product to one customer, that customer will then use the technology in my product with their friends and family and colleagues, and so they will actually lead to additional sales down the road. Other issues, though, that deal with the value of future customers include the ability to keep a customer with your technology, and that if the technology allows them to continue their behavior that they currently have, they'll continue to buy our product and be able to use our product. Future changes in technology or other key success factors, then we don't want them to completely disrupt our customers' behavior, because then they'll go to a different product and they won't continue to use our product. They'll chase the new technology that's actually being used. We also are concerned with the competitive structure of the industry, which could impact the value of our market share. If we have a lot of competitors coming into the marketplace, the dynamic of the marketplace or the structure of the marketplace will change, and again, it'll impact the value of our customer base today in the future. And this also includes the market as well. If the market becomes very fragmented, so in other words, if we have a mass market and then the market becomes segmented many times over, we think of that as fragmentation. Every time the market fragments or segments or breaks apart into smaller groups, it becomes harder and harder for one firm to be able to serve the entire marketplace. So there is this notion that customers today are worth more now than if we acquire them later on. So the value of a customer is greater today than it would be in the future, kind of like any other investment would be. However, there are certain issues associated with this. So the ability to be able to network, have a network effect enhances this notion. However, if there are strong technological changes or competitive structural changes, or changes in the marketplace, this really impedes this notion that share gains today are worth more than they will be in the future. So it's a big caution then for followers to consider. If they feel like, if a follower feels like the marketplace and the industry will remain fairly stable, then that's motivation to jump in now. Otherwise, if there's a lot of inconsistency or uncertainty in either the marketplace or the industry among competitors, then that'll be a caution flag for competitors, for followers to jump in and try to make an impact now. Thinking about competition then, one of the things that that followers kind of think about would be how much impact they can have in the marketplace, or in the growth stage in particular. One of the nuances that happens is competitors jump into the marketplace, and we've got this market that's growing, and the market that's growing sends a signal that there are lots and lots and lots of buyers out there. And so if there's a lot of buyers out there, then there are more buyers than there might be supply. And so if that's the case, then a lot of times we can raise our price, and the individual companies that are currently in the market have a lot of control over the market. The problem with that is eventually we run into this issue called overcapacity. And so like we have the introduction stage where we have very, very few competitors, and then demand outpaces capacity for a short time in the growth stage. So this is this idea that the market is really, really driving, kind of the whole industry, and then a bunch of competitors jump in, and all of a sudden we have overcapacity. We have more product being produced than demanded, just as the demand curve is starting to slow down during the shakeout period. So that's kind of an issue that, again, it sends a bit of a red flag up, because do you want to jump in to a product category that's heading towards overcapacity? And once we hit overcapacity, we know companies and firms are going to start leaving and be flushed out. Markets exert little pressure on prices initially, because firms can charge a higher price because of the supply and demand issue, and they can charge a higher or gain a higher margin. This looks super attractive to companies that are coming in. This price incentive then is important for bringing companies into the marketplace. The problem, though, the big danger is this is a short-lived stage. Prices seem attractive now, and it seems like I'm going to gain a lot of margin now, but once we have a bunch of firms come in, that price attractiveness is going to go away, because we're going to have to lower our price to fend off and defend ourselves during the shakeout period. Okay. So this is, again, one of the considerations that the followers make. So early entry, we think is something that's critical for technology, and then also experience that's being gained, and also for the value then of the customer. Gaining customer share early is more valuable than gaining customer share or market share later in the product development stages. So early entry is needed. If there's a steep learning curve, or if there's technology that needs to be learned, the firms that are in the marketplace earlier will will be rewarded. So as a follower, then we want to think about how much information is needed in order to be able to produce the product. We want to be able to think about gaining market knowledge, learning from pioneers, but understanding that typically the earlier we're in the marketplace, the more success that we're going to have. Okay, so these are some considerations to think about during the growth stage. The growth stage is a very, very dynamic period for the structure of the industry and the structure of the market at the same time. And there's a ton of uncertainty going on here. We just simply don't know a lot of times what's going to happen. And so market entrants, the companies that come in, often come in with these rose-colored glasses without really thinking about how the structure of the industry and structure of the product market is going to change. And so this takes a lot of caution and a lot of foresight to really think about what's going on. So we talked a little bit about the growth stage challenges and the opportunities and the risks that are developed here during this time period, thinking that for the follower in particular, the gains that we can gain and share can be easy if the pioneers and leaders are weak. That's a possibility, however, that's not a certainty. We also are sometimes under the illusion that or understanding that gaining market share today is worth more than later, and that's absolutely true, except if strong technological changes take place or structural changes in the industry or the marketplace both take place, then what we offer customers today might not be what they want here in another few weeks or months or years as we enter the shakeout phase and so forth. So maintaining gains now are fine, but it doesn't mean that we're not going to have to change to meet other expectations that the marketplace has. So other issues deal with price competition, early entry being necessary to maintain technical expertise, and so forth. This price competition issue is the issue where we think about demand and demand outpacing supply in the growth stage, suggesting that we can raise price and act in an oligopoly or monopolistic type of a way because supply is low and we can control the marketplace. However, that is going to go away as soon as we hit the shakeout period. So this price competition, while it's less intense during the growth stage, it's going to be much more intensive during the shakeout phase. Okay, so these are just some notes and some ideas then about the growth stage and growth markets for both pioneers and for followers.